Hello, I'm Greg Ninnis for interest.co.nz, and today I'm talking to David Plank, who's the Head of Australian Economics for ANZ Bank in Australia. Welcome, David.
Thank you.
The Australian housing market's in a downturn at the moment,
Yes.
and ANZ Bank has recently revised its forecast for the Australian market and is now expecting prices there to decline by 15 to 20% from their peak. When was the peak in the market over there?
So that's the decline we're looking for in Sydney and Melbourne, smaller declines elsewhere, and that really reflects what's driving the price declines. The peak was in 2017, and if we're right that prices are down sort of 15% plus in Sydney and Melbourne, putting that in context, that kind of takes prices back to where they were in 2014-15. So this fall that we're expecting comes after what was a very big run-up.
And sustained rise in prices
that's right.
as well. Why is it different in Sydney and Melbourne to other parts of Australia?
So when we look at the drivers of this downturn, we think it's very much related to a credit tightening. We saw...
So the bank's lending less money into the housing market?
Yes, and the criteria on which they're lending changing. So we saw in early 2017 the regulator made a change to its thinking about investor lending, and so we saw the banks tighten up the criteria around investors. And the housing market slowed through the course of that year, and then prices actually fell in Sydney. But by the end of 2017, early 2018, we'd seen broad stability back into the market. Prices had stopped falling. Other indicators like the auction clearance rate were starting to recover, and we thought the market was going to enter a period of broad stability, if you like, through the course of this year. Then we had, in sort of March, we had another event. We had the Royal Commission, and the initial focus of the Royal Commission was on mortgages and so on, and that led to a further tightening of credit in terms of the criteria the bank applied, various banks applied, and so on. And essentially, from that month onwards, we saw another sharp downturn with the auction clearance rate falling quite sharply and prices, initially in Sydney and then in Melbourne, and then broadening out across New South Wales and Victoria, started to decline. And then it was an issue about how far and how deep that would go, and so we published a number thinking that Sydney and Melbourne would be down sort of in the order of 10 to 15%. But for that to be right, we had to start seeing signs of stability in the market or lesser declines in prices by now. In fact, what we're seeing is actually further, more steeper declines. In the month of November, prices accelerated to the downside. So it became clear a month or so ago that our forecasts were not bearish enough, mainly in Sydney and Melbourne. Actually, the rest of the country was doing as we'd expected. So we revised it down, like you said, to sort of that 15 to 20% range, which, if we're right, will be the biggest fall ever in nominal prices. But as you said, it does come after a sustained period of increases, which I think is important to put that decline in context.
Okay. So it started with investors being less active in the market, and now it's spread to, first home buyers and people who are trading up from one house to another as well?
So what we saw, the initial impact from March of this year was on investors. So investor lending fell quite sharply. But owner-occupied, which both first-home owners and upgraders remain still quite active. But we're now starting to see quite a sharp slowdown in lending to those people as well, which I think is driven more by a change in perception about the market. So I think what's happened is the initial trigger, if you like, for the event was a credit tightening. But what we've seen now is, as prices are starting to fall, that's changed expectations. And so people are now much more bearish on the market. And so I think you're now starting to see the demand side. Is
there something in this of it being a little bit self-fulfilling, in that presumably the reason that credit was tightened was that people were thinking the market was a bit overheated, and perhaps they needed to cool that a little bit, and then so you tighten the lending criteria, reduce lending, that becomes self-fulfilling and brings the market back down. Is that more or less what's happened?
So I think that was the thinking of the regulator back in March of 2017. They wanted to take the heat out of the investor side of things, so hence the focus on investors, and that did work and did happen. I think this year the focus on the issues that have been raised at the Royal Commission is a broader impact. A lot of it's around process and information rather than reduction in the amount of credit, but there has been a reduction in the availability of credit in terms of what the maximum people can borrow. And while that probably doesn't affect most people, as always, economics operates at the margin and the marginal person, and the marginal person has been impacted. And now I think what we're seeing is a Yes, you're right. In a sense, it becomes self-fulfilling as expectations change, and we've seen quite a significant change in expectations. There is, though, in terms of where does this go and how does it cure itself, as prices come down, of course, affordability goes up. As relative prices change, you see it creates opportunities for some people. Mm-hmm. And there are some indicators out there that are telling us that people now are thinking maybe there's more value. So there's a survey that one of the other banks does, and one of the questions they ask is about, is it a good time to buy a dwelling? Mm-hmm. And that indicator is actually rising quite sharply. Mm-hmm. So that's telling you that people are now saying that maybe we're not in the market and we're kind of squeezed out because they couldn't afford, are looking at prices that are down 10% already in Sydney, and of course that's the average, which means some bits are down by more, are now thinking, well, maybe it is time to start looking.
But surely if they think they could go down 20%, they'll think, oh, wait.
So there can be a lag between people starting to think it's a better time to buy a home and when they actually transact.
Okay.
And they still have to get credit, of course, which could be harder.
The reduction in lending by the banks, was that just into the housing sector with mortgages, or was it in other areas as well?
So the banks are still growing. The amount of credit is still growing, so it's not like the banks have actually withdrawn credit per se,
right.
But because the amount each person can borrow is less, obviously that affects affordability. Mm-hmm. The main focus was on consumer lending, so mortgages. Also, we're seeing an impact on car finance. So if you look at motor vehicle sales, they're down as well. And I think that reflects, I don't think that's a wealth effect. I don't think car sales are down because house prices are down. I think car sales are down because, again, it's harder to get finance for cars. Mm-hmm. But more generally, I mean, the concern is whether, a lot of small enterprises, companies, self-financed, and the source of finance is a mortgage on the house.
Yes.
So one of the concerns is whether this credit tightening impacts businesses more generally. Yeah. And there is some, the government, for instance, is looking at a policy to potentially inject more competition into that market, which is an interesting policy idea, so perhaps addressing that concern. If we look at businesses more generally, actually business confidence or business conditions, businesses are telling us that things are pretty good. And so we're seeing employment growth remain strong. We've seen business intentions in terms of investment rising. So at the moment, for the most part, it seems this correction in housing is happening sort of over here. Mm-hmm. And if you look at everything else other than housing, the Australian economy looks pretty good.
Okay.
The issue then becomes, can we have a sizable correction in house prices? And this will be, as I said, one of the largest, if not the largest we've ever had, without it having flow-back effects to the rest of the economy more broadly. And that's essentially the million-dollar question that people are trying to form a view on. And depending on how big you think the impact will be and the flow-on, changes your view a lot about where the economy ends up over the next year or two.
Okay. One of the features of the New Zealand market up until a couple of years ago was that we had a big inflows of capital from China into our housing market. And that really took a serious downturn in late 2016 when the Chinese government applied restrictions on taking money out of the country. And that had an immediate impact on our housing market here. Did you see the same thing in Australia?
So yes, we've seen a reduction in foreign buying from, if you look at it probably peaked at about 25% of new builds in Australia. Foreign non-resident investors can only buy new dwellings.
Right.
So, and they were buying at the peak. If you look at the data, the data's a bit hard to get, but there are various sources. So it probably peaked above about 20-25%. And now the data would suggest, we do a survey with the Property Council of Australia, and one of the questions they ask developers is how many properties are you selling to foreigners? And that's come down to probably an average of around 15%. Hard to see that having any, I think that was one of the headwinds through last year for the market.
Yeah.
But when you kind of line up when the market slowed in 17 and then again this year, it's much more about the credit events than about the tightening of or the reduction in foreign buying.
And how are all of these things affecting the new build market, or is it just confined largely to resales and things like that?
So what we've seen is, again, we have one of the questions in the survey with the Property Council, they ask about the availability of debt finance. And that tightened up dramatically in March of this year. And subsequent to that, for developers, and subsequent to that, we've seen a fall off quite a sharp fall off in building approvals. And what's happening there, of course, is it's much harder to get pre-sales. So for that reason, developers are finding it harder to get finance, and so we're seeing a fall off in building approvals, which we probably would have seen anyway because we'd reached a level of activity that probably couldn't be sustained on an ongoing basis.
Okay. That may be one of the differences between Australia and here as well, in that Australia, I believe, has had something of a building boom in the housing market the last few years, whereas in New Zealand we haven't been building enough.
So even in Australia's case, that building boom came after 10 years of underbuilding.
Right.
So if you look at when we were at the peak just recently of completions and new dwellings, actually we were probably building what we should be building, not overbuilding.
So you don't see a glut developing?
No, we see, I think, pockets of increased supply. The only city in which the rental vacancy rate is rising is Sydney.
Okay.
So everywhere else, including Brisbane, which did have a big supply increase a couple of years ago, rental vacancy rates are actually falling. So there's no evidence of, I suppose, systemic excess supply. And if we have a couple of years in which the level of building declines, and we think the level of residential investment in the residential construction over the next few years will fall kind of 20%-ish, which by historical standards is actually not that big a downturn. Historically, the big downturns can be very large. If we get that kind of downturn and we have a couple of years of less building, given population growth, ongoing population growth, which we will continue to have, then any thought of excess supply disappears quite quickly. One of the issues, though, I think, and perhaps this is I don't know the New Zealand market well enough to know whether there's an issue in New Zealand, but one of the issues is whether the apartment market is appropriate for owner-occupier versus investors.
Right.
And I suspect that, and I kind of know really, that there's too many 1- and 2-bedroom apartments and not enough 3- and 4-bedroom apartments.
In Sydney and
Melbourne and Brisbane and so on. So what I think will happen is that over the next few years that there will be a significant shift in the way apartments are built in terms of if you're building them for owner-occupiers, then 1-bedroom apartments don't make a lot of sense.
Right.
So I think
because it's harder for single people, for example, to be able to afford their own place without a partner's income, and other people with families or thinking of a family are going
1-bedroom apartment's too small.
Yes, right.
So they want 2 or 3 or 4, and I think there's a shortage of that kind of stock.
So that's a demographic shift, really, isn't it?
Well, I think there was a view, I think, that the apartments were going to be for investors, or for single people. But for affordability reasons and changes in where people want to live and so on, I think increasingly, as our cities get bigger and Sydney and Melbourne are effectively on track to become as large as London over the next 30 or 40 years, if we think about what that means, unless people are going to live on the absolute periphery of the city, they want to live closer to the centre in an affordable way, then apartments or townhouse type developments are what people are going to have to live in.
Right.
2-bedroom apartments don't make a lot of sense.
Okay. How much is immigration a driver of population growth across the Tasman?
The vast bulk.
Right, okay.
Pretty much.
And
not quite all of it, but
are the
most
trends changing there at all?
I think there's the current government has talked about reducing permanent migration from 190 to 160,000 in terms of the level, and effectively we're operating at that 160,000 level. So I think that wouldn't surprise me if that became the consensus. I mean, that's a modest reduction. I don't think that reduction really fundamentally changes things all that much in the scheme of things. And New Zealanders are not counted in that permanent. So if Kiwis start going back to Australia again, and obviously one of the big changes for New Zealand was net migration to Australia fell sharply. Yeah. If we see a return to the kind of the historical levels of net migration, then that means that 160 is actually a bit higher than that because you get 20 or 30,000 Kiwis coming over. So.
Okay, and you also have high internal migration with people coming from other parts of Australia, and particularly into Melbourne and Sydney?
So Sydney is generally a net loser
really?
in interstate migration. So what you typically see is a strong correlation between the Sydney-Brisbane price differential. When it's wide, as it is now, people leave Sydney to go to Brisbane. That was actually, usual historical pattern was actually delayed. If you look at the data, there was actually relatively little interstate migration a few years ago because the Brisbane labour market was in relatively poor shape. So people weren't moving, even though the price differential was there for them to take advantage of. So they could either buy the same home for a lot less or buy kind of double the home for the same amount.
Right, but they just want a job at the same time.
They needed a job. So as Queensland economy has improved quite significantly over the last couple of years, you've seen quite a sharp response. And so, I think that pattern will continue. Sydney is an expensive city to live in. Housing's a lot more expensive than it is in Brisbane. So so what you tend to see is new migrants coming into Sydney and Melbourne, and then over time you see interstate migration from New South Wales and Victoria into some of the other states, principally up into Brisbane, I think, to take advantage of the lower cost of living. But it depends, obviously, on the state of the job market.
Okay. One of the other major drivers, of course, of the housing market is interest rates. And what do you think the trend is over there as far as interest rates go for mortgages?
So we don't think the RBA is moving interest rates for quite some time. If they ultimately move interest rates up, which is actually our forecast, but not for a couple of years, that's a good news story, because that tells you that there hasn't been a negative flow on from the housing correction into the rest of the economy.
They think the economy can withstand
and we've got lower unemployment and higher wages. So hopefully the next move in interest rates is up, because that actually is a good news story. But for the next 18 months or so, 2 years perhaps, we don't think there'll be any move. The real question then will be, do bank funding costs change, and competition? What happens there? Is there pressures on funding costs to go up? And there have been over the course of this year. We've seen market interest rates rise, and that's put some upward pressure on the funding costs of banks. And that saw a few months ago the banks raise floating interest rates a little bit, not all that much. But up until then, actually, mortgage rates have been falling, so we're kind of back to where we were a year ago. I do think, though, that depending on how long the housing slowdown lasts, at some point the banks, at the moment the banks are sort of adjusting their criteria and still in the process of adjusting to, if you like, the new credit conditions, and that will probably continue through next year, certainly the first few months of next year. But at some point, often what happens is, in a sense, we overachieve. And if credit growth slows too much, it's still the case that banks make money on a mortgage, as you'd hope they do. They get a return on their capital. So
that's
ultimately,
what they're there for.
Yes, that's ultimately not it doesn't make sense. Banks ultimately they don't want to shrink their business, if you like, a profitable business. So, I think at some point you're going to see reasonably intense competition. In fact, we are for high quality borrowers. Mortgage rates, if anything, are probably still coming down because there's a lot of competition.
Right. So eventually, as prices fall and the rest of the economy is performing okay, so people's wages may still be increasing, the cost and interest rates aren't going up, so the cost of a mortgage is declining. That makes buying a home more attractive to a buyer. It also increases the rental yields for investors.
Yes.
So at some point they're going to be looking at that and thinking, we should start piling back in again. When do you see that happening?
So I don't know if they'll pile back in, but yes, no. So how do you get out of this? Prices don't fall forever, and they don't fall forever because eventually, like you say, as prices change, behaviour changes, and that's an important lesson of economics: is relative prices matter. So as I said, we're already seeing people's views about whether it's a good time to buy rising. We do a index which looks at Google searches for housing. As Google searches go up, obviously there's a lot more interest in the housing market, and that index has reliably led previous upturns in the housing market. That's actually rising sharply as well, which again is telling you that people are thinking about it. Whether they're acting is another story, and I don't think they are, because they're cautious, and obviously the credit
probably
story.
watching it like hawks.
But I think there is a lot of focus on it from people who haven't got into the market over the last few years. I think, though, when we look at the Royal Commission's reporting early next year, and then we have an election where there's potentially some policy changes around housing, I think those things suggest that a degree of caution until late next year, probably. So by late next year, our view is the price impact, the affordability metrics, if you like, have changed enough that we should start to see the market stabilise. I wouldn't, though, expect a dramatic surge in pricing. I think we're in a different environment from that, and probably given where prices got to in terms of ratios to income and so on, you don't want to see another surge.
A steady improvement, perhaps.
Yeah.
Okay,
yes.
That's great. Well, it sounds like next year's going to be an interesting one for the housing market in Australia, whichever way it goes. And
yes,
thanks for coming through and talking through that with us today.
Pleasure. Enjoyed it.
ANZ have done quite a comprehensive report on the Australian housing market, and we'll be attaching that to this article for those readers that want to have a good chew on that. And thanks for joining us today on interest.co.nz.